Welcome to this week's Blackboard Fridays video, where we're going to be talking about money. And I'm going to focus on money because money is exciting and energizing, whereas doing math tends to be a little bit boring for most business owners. However, there's some simple math that we may be able to do to help you make more money. That ought to keep you engaged for the next 4 to 5 minutes. Now, interestingly enough, we've done a review of all the Blackboard Fridays topics that we've discussed, and I haven't spent a whole lot of time talking about your capacity engine. This is a key tool that I use with an awful lot of my clients to help them identify where there's hidden profit sitting in their business and set some trigger milestones for when they need to grow. If you think of your business, all of the team, the resources, the technology you've got, you can abstract all of those into the concept of an engine. When they're working together, they're humming, all those little cogs and pistons powering away, they're going to create a certain amount of output, which in a business we tend to define in terms of dollars. How much money can your team produce on a monthly basis? Now, an engine has certain capacity, certain amount of power that it can put out when everything's running well together. What I encourage my business clients to do is to calculate what that figure is for them. Because you're probably bogged down in the stuff. You're a busy business owner. And if you ask your team, they're also going to tell you that they're busy, that you need more resource. But do you actually need to invest in that growth yet? Or is there some waste, some inefficiencies built into your current engine that you can get rid of to put more money in your pocket or to create some spare cash to invest in that future growth? So to do that, the first thing we do is calculate the capacity of your engine. What is that 100%? And then if we look at the utilization rate, how much of that revenue are you actually achieving each month? The gap between those two represents waste in your business. How much waste you tolerate is going to depend on how you want to feel on the journey. You might be happy with a lot of waste because that allows you to grow quite fast. But most business owners I talk to want to get rid of some of that before they're ready to grow. They just struggle on where to start. And it starts with calculating your capacity. Now, the more complex your business, the more detailed you may need to go in order to calculate this. But I want to talk about the 3 most common ways that you can calculate the capacity of your business and as a result, see how much money you might be leaving on the table each month through inefficiencies. The first is a very simple hourly rate. If you've got 10 accountants who each bill $200,000 a year, then the capacity of your business is 10 times $200,000. Hourly rate is definitely the simplest way to calculate your capacity, but most businesses are starting to shift away from that. Teams don't like calculating all of the time that they're doing. Clients don't want to be on the clock the whole time. They want more of a value-based conversation. And so increasingly, I find businesses are talking about their capacity based on the value of the projects they're delivering or the clients that they're managing. This is a slightly more complicated process, in part because unless you can separate each individual and the clients that they're working on, it tends to require you to have an understanding of how your team work together, how many client-facing staff you might need versus the administrative staff to support them and the business development or growth staff to keep feeding them the work. That team mix can then simply be multiplied by the number of clients that they can manage on a monthly or yearly basis, and then multiplied again by the average dollar value of each client. It's a little more complex than just 7.5 hours a day by an hourly rate, but it is something that is achievable for most clients. And indeed, to let you in on a little secret, a lot of clients who are value-based really do bring it back to time anyway. The third way to calculate capacity can get a little more tricky. And this is when you start to break up different divisions within your business, when your customers or clients start to touch multiple areas that each have their own level of capacity. So as the customer goes through the journey, they might deal with sales and then the onboarding process for your business, maybe the actual delivery of the work, and lastly, often the accounting department when they get their invoice and have to pay it. You can actually go through and calculate the specific capacity for each of those. How many sales can your sales team bring in each month? How many new clients can you onboard? How many actual client projects can your delivery team, as it currently exists, deliver in each month? And then from the accounting department, how many invoices can they get out? How many debtors can they analyse? And what you will discover is that some of those teams are going to have a smaller capacity than others. Those are the constraints within your business. As an example I ran with a client, we did this and they felt they needed more sales. They needed to grow the revenue of the business, and the inefficiencies they saw were within their sales team. When we calculated it, indeed, their sales team was doing quite well and could add some more people. Their onboarding team, however, was challenged. There was enough new clients coming on that they were struggling to keep up with them. Adding a new salesperson, bringing in more new clients was going to completely overwhelm them. We needed to increase the resource in that onboarding team in order to release that capacity so that the sales team could push more revenue through the business, to get more power out of that engine. Think about your business. Think about, even on a gut feel level, how much you feel when everything is humming, your business is able to generate each month. And then do the analytical element. I encourage you to do that because when you do the numbers, it's much easier to share the assumptions and the calculations with your team, to get the buy-in from them so that they, not just your gut, recognize the waste that exists and can then work together to reduce that waste, put cash in your pocket and help fund the future growth.